That is a real, was about compliance. Yes, with a substantial equity kicker, that is a
Fix the underlying business metrics. It just sign of a market structure under
that big pharma and insurance companies actually
usually means the stock just fell into a
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
$35.68. That was the closing price for Brand Engagement Network, ticker BNAI, as of the final bell on February 28th, 2026. If you are tracking the capitalization, that puts the market cap comfortably over $160 million, with an enterprise value sitting right around $164 million. But, the number that really forces you to stop and stare isn't just the price tag. It is the sheer velocity of the move. Heavy volume, intense volatility, and a 12-month market price return of 792%.
It is an explosive number, I will grant you that. But when you look under the hood of a 700% rally, the engine room looks incredibly different depending on where you are standing. We are looking at a company that has effectively transitioned from a micro-cap penny stock to something attracting Tier 1 capital. The question we really have to wrestle with today is whether BNAI has genuinely transformed into a regulated AI player, or if we are just looking at a valuation mirage, driven by a low float and some very clever financial engineering.
Yeah, I think mirage is far too cynical a word for what the hard data is actually showing us. I would argue we are witnessing a pivotal epoch for the company. The narrative for Brand Engagement Network has fundamentally shifted in early 2026. We aren't looking at a speculative penny stock anymore. We are looking at a structurally reformed entity. They have cleaned up the balance sheet, they have attracted premium capital, and I mean significant premiums over market price, and they have brought in institutional heavyweights like Goldman Sachs. This is a real transformation story.
Right.
It is not just numbers on a screen. It is institutional validation.
I see why you characterize it as a transformation, but I just come at it from a completely different angle. I see a company where the valuation is technically driven, not fundamentally earned. The rally is almost entirely multiple expansion. Think about that for a second. Over 790% of that growth is just multiple expansion, not revenue growth. Investors are just paying more for the exact same dollar of sales.
You have a stock trading at a price-to-sales ratio of nearly 1,800. That is a number that demands absolute perfection in execution. Yet we are seeing severe operational risks, and reputable data providers are flagging a high risk of bankruptcy. And let's not forget the dilution. Total shares outstanding grew by roughly 53.8% over the past year alone. Let's dig into that bankruptcy flag immediately, because I think you are anchoring on historical metrics that the company has already completely outgrown. If you look at the sequence of events in early 2026, the intent is clear. The most significant move, the one that really stopped the bleeding, was the termination of the Standby Equity Purchase Agreement, or SEPA, on February 5th.
For the benefit of anyone listening who doesn't spend their days reading SEC filings, let's clarify what a SEPA actually is.
Sure. In the microcap world, a SEPA is often the lender of last resort. It is a facility that allows a company to sell shares to a lender at a discount to the market price. The lender usually dumps those shares immediately onto the open market to lock in a profit. It creates constant, crushing selling pressure. It is, frankly, toxic financing. BNI killed that facility. They walked away from $50 million of potentially dilutive, toxic cash. That is not the behavior of a company going bankrupt. That is the behavior of a company fixing its foundation.
Okay, terminating the SEPA was a good move. I am not going to argue that. It stops the immediate death spiral. But you have to look at what replaced it. A company with this kind of operational burn rate cannot run on good intentions alone.
What replaced it was quality, high-conviction capital. They replaced that toxic backstop with a private placement from Ben Capital Funds I. And I really want to stress the pricing here because it is critical to the bullish thesis. Ben Capital put in over $1.5 million, priced at $63.25 per share. At the time, that was a massive premium to the market.
Smart money does not pay a premium like that unless they see an internal roadmap that justifies it.
Or unless the capital structure is so convoluted that the headline price doesn't tell the whole story. You mentioned the structural cleanup, but we cannot ignore the absolute chaos that preceded it. The reverse stock split in December 2025, a 1-for-10 split.
Which was a strategic necessity to get them.
It was a survival tactic to avoid delisting, and it caused total confusion. You had a situation where the public warrants, the BNAI, were adjusted to an exercise price of $115. But because brokerage systems were incredibly slow to update, classic information asymmetry in these low-flow plays, you had retail traders trapped in volatility they didn't even understand. And while you celebrate the Ben Capital investment at $63, let's not forget that the company has outstanding warrants with exercise prices as low as $3.70. That is a highly confusing, contradictory valuation picture.
The reverse split was about compliance, yes, but it was also about graduating the stock. Institutional funds, the big pensions, the endowments, they often have strictly enforced mandates preventing them from holding sub-dollar securities. By executing that split and stabilizing well above the dollar mark, BNAI made itself eligible for institutional portfolios. And that is exactly what happened. It wasn't just cosmetic. It quite literally opened the door for the Goldman Sachs entry.
Well, let's talk about the Goldman Sachs entry, because I know this is the linchpin of your argument. On February 9, 2026, Goldman filed a Schedule 13G disclosing a 5.8% stake. That is 274,000 shares.
Exactly. It validates the technology. When Goldman Sachs takes a nearly 6% stake, it moves the stock from the retail speculation bucket into the lit institutional portfolio bucket. And they aren't alone here. We saw filings from Vanguard, UBS, Geode Capital Management. This is the institutional convergence I am talking about. They are buying the infrastructure of AI, and they have clearly identified BNA as a component of that. Not to mention, BNA used recent warrant proceeds to pay off about $640,000 in loans, including debt to Hana Bank in South Korea. They are cleaning house.
I am just not convinced by that line of reasoning because you are conflating passive accumulation with active conviction. The Goldman filing was a 13G.
Which means it is a standard institutional holding.
On the board or shake-up management. A 13G usually means the stock just fell into a specific algorithmic basket. Goldman likely bought it because their quant model said buy AI infrastructure, and BNAI finally fit the market cap criteria after the split. They aren't seeking governance control, they are likely just riding the broader macroeconomic wave.
Passive or not, it is a vote of confidence with real capital. It soaks up the float.
But look at where the trading is actually happening. This is where the valuation mirage argument gets its teeth. If you look at the FINRA Trade Reporting Facility data, the TRF data, off-exchange short volume is frequently exceeding 50%. It peaked at over 61% on February 20th.
High short volume can simply indicate liquidity provision by market makers. It doesn't necessarily mean the whole street is betting against the stock.
It indicates that the liquidity isn't on the lit exchange. When you have that much volume moving through dark pools and off-exchange venues, it tells you that market makers like Virtu and Citadel are heavily involved. They are likely hedging positions against retail flow. They aren't buying because they believe in the engagement language model. They are buying and selling to capture the spread on retail exuberance. And we saw the cracks in the liquidity back in December when fails to deliver spiked to over 1.06 million shares. That is a sign of a market structure under extreme stress, not healthy institutional accumulation.
I think focusing entirely on the plumbing of the market ignores the actual architecture of the business they are building. You are looking at fails to deliver from December. I am looking at the business model today. BNAI isn't trying to build another ChatGPT. They are building closed-loop, privacy-preserving AI for highly regulated sectors. Look at the Valeo Technologies partnership in Africa.
I have looked at it.
Then you know it is a textbook example of their strategy. They secured a $2.05 million preferred equity contribution. They have a 35% revenue share, and critically, they are running a pilot with Nelson Mandela University that specifically blocks public internet access to ensure student well-being. That is sovereign AI. That is GDPR, HIPAA, and SOC 2 compliance in action. That is a real defensible moat.
It is a pilot. And while the equity contribution is nice, we have to be realistic about the actual revenue generation. You are valuing a company at $160 million based on a pilot program and a partnership with an entity in South Africa. The company's historical revenue is minimal. In 2024, the market cap was $3.5 million. Now it is $160 million. Has the revenue potential really increased 40-fold in 2 years?
The market is always forward-looking. It is pricing in the agentic AI potential. They have the collaboration with Microsoft on AI for robotics. They have the pharma deal signed in December that is expected to add $250,000 in revenue immediately. These are retrieval augmented generation systems that big pharma and insurance companies actually need because they simply cannot trust open source models with their proprietary data.
That is a very compelling narrative, but have you considered the financial health required to survive until those enterprise deals actually scale? Trifis data from late February flags a high risk of bankruptcy. The current ratio is below 1.0.
Let's quickly define that for the audience so we are clear on the exact risk profile we are discussing.
The current ratio is a straightforward measure of liquidity. It compares a company's current assets to its current liabilities. A number below 1.0 means that, theoretically, if all your short-term debts came due tomorrow, you would not have enough cash or liquid assets to pay them off. It indicates severe, immediate liquidity constraints.
Which is exactly why the Ben Capital deal and the recent warrant exercises are so critical. They brought in immediate cash.
They brought in some cash. But let's talk about insider sentiment. If this transformation is so obvious and the company is fundamentally undervalued, why aren't the insiders buying? The only reported insider transaction prior to this massive rally was Venkata Ramana Pennam, the senior vice president of engineering, selling shares in December at around $2.58.
That was a relatively small transaction, likely for tax purposes or personal financial planning.
It was the only transaction. If I am a senior executive and I know my company is about to pivot to a premium valuation with Goldman Sachs backing, I am not selling at $2.50. I am buying everything I can get my hands on. That lack of insider buying suggests to me that the management team might be just as surprised by this price action as the rest of us.
Or it suggests that executives have diverse, immediate financial needs. I just don't think we can extrapolate the entire future of the company from one executive stock sale. The fact remains, investors are actively exercising warrants for cash. In late January alone, over 33,000 warrants were exercised, bringing in roughly $818,000 in proceeds. These investors could have just sold the warrants on the open market, but they actively chose to convert them to equity. That shows a willingness to put hard cash into the company's future.
It is a sign of short-term speculation. We have to look at the broader analyst consensus. I know analysts aren't always right, but the spread here is alarming. The average price target is $20.40, with a low of $20.20. The stock is currently trading around $35. That implies an upside-downside gap, a downside risk of roughly 42.8%. That is not a margin of safety. That is a trapdoor waiting to open.
Analyst targets are famously lagging indicators, especially with high-velocity tech stocks. They are looking at trailing 12-month data. They aren't properly pricing in the repricing of sovereign AI. When you have a company that can go to a government or a healthcare provider and say, we can give you AI that doesn't leak patient data to the public internet, that commands a massive premium. That is what the market is pricing in right now, the scarcity of fully regulated AI agents.
But you are paying a price-to-sales ratio of 1,789 for that scarcity. That is astronomical. Even if they execute perfectly on the pharma deal and the Africa partnership, it will take years to grow into that valuation. And in the meantime, you still have the dark pool mechanics, the looming potential for more dilution, because let's be honest, with a current ratio under 1, they will inevitably need more cash, and the inherent volatility of a low-float stock.
The warrant restructuring directly addressed the overhang, though. By moving the public warrant strike price to $115, they effectively cleared the deck. They removed the ceiling. Now the stock actually has room to run without that constant technical selling pressure from warrant holders looking to cash out at $11.
They moved the goalposts, yes,
but that doesn't magically fix the underlying business metrics. It just changes the mechanics of the derivative market.
It signals intent. It signals that management fundamentally believes the stock is worth significantly more than the old strike price. And combined with the SEPA termination, it shows they are playing a long game now. They aren't looking for quick, toxic cash injections anymore. They are deliberately building a capital structure that can support a multi-billion-dollar valuation eventually.
Eventually is a very long time in the financial markets. And right now, the disconnect between price and value is undeniable. You have a company that has successfully engineered its way out of penny stock purgatory. I will absolutely give them credit for that. The reverse split, the SEPA kill, the carefully timed partnership announcements, it was brilliant financial engineering. But financial engineering is not the same thing as building a sustainable, profitable business.
It is the foundation of a profitable business. You cannot land enterprise contracts with Microsoft or major pharmaceutical companies if you are trading at 40 cents on the pink sheets. You need the credibility of a major exchange, the backing of institutions like Goldman, and a clean balance sheet. They have built the launchpad. Now they are just fueling the rocket.
A launchpad built on a current ratio of less than 1, an evaluation that assumes they're already in orbit.
Let's look closer at the specific products, though. We aren't just talking about generic open-source chatbots. We are talking about engagement language models, or ELM. The agents they are deploying for things like type 2 diabetes support or for rheumatology, these are highly specialized. They are trained exclusively on institutional vetted data. This is exactly where the industry is going. The era of the do-everything hallucinating model is ending. The era of the specialized compliant agent is beginning. BNAI is positioning itself right at the center of that shift.
I actually agree that the industry is heading in that direction. My concern is whether BNAI has the actual financial and computational resources to compete there. They are up against massive incumbents with infinitely deeper pockets. And while the closed-loop pitch sounds great on an investor deck, is it truly proprietary enough, or is it something a larger, better-funded player can replicate in a weekend? The current valuation assumes they have an impenetrable moat. I am just seeing a muddy ditch.
The partnership with Valio suggests otherwise. A perpetual licensing agreement with a substantial equity kicker? That is a very sticky relationship. That isn't a simple vendor contract. That is a strategic partnership embedded in the infrastructure of another continent.
It is a partnership in a market that is still very much developing. I just want to see the revenue actually hit the income statement. Until I see the cash flow from these agentic AI workflows genuinely covering their operational burn rate, I have to remain highly skeptical.
I think we are just seeing the classic tension between value investing and growth investing play out here. If you wait for the cash flow to be completely obvious and de-risked, you miss the 700% move. The market right now is paying for the pivot.
And the market often drastically overpays for the pivot. That is precisely how bubbles are formed.
To summarize my view on all this, BNAI has successfully graduated. They have left the toxic financing of their past behind. The combination of terminating the SEPA, the entry of Goldman Sachs, and the strategic closed-loop deals in Africa and pharma provides a solid floor that simply did not exist in 2025. The price action we are seeing is a rational repricing of a company that has essentially become a proxy for regulated, sovereign AI demand.
And to summarize my view, while the financial engineering was indeed successful in avoiding a delisting scenario, the underlying business is still in early-stage peril. You have a 42% downside risk to current analyst targets, persistent operational losses, and a massive valuation that is completely decoupled from their current sales figures. Without sustained, proven revenue from the ELM platform, that liquidity crunch could return very quickly.
That is certainly the risk with any high-growth technology play. But the Goldman stamp of approval, even if passive, suggests that some of the smartest capital in the room thinks the risk might just be worth taking.
Or it suggests that even the smartest capital in the room is just mathematically chasing the exact same AI momentum trade as everyone else.
It is undeniably a fascinating case study in both market mechanics and enterprise AI adoption. Whether BNAI becomes the next great AI infrastructure play or just a temporary beneficiary of market exuberance, well, that remains to be seen. But at a $160 million valuation, the stakes are certainly much higher than they were a year ago.
Indeed. The market has placed its bet. Now the company actually has to deliver.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!